You're listening to Indications by the Conference Board.
Hello, welcome to Indications. I'm Elizabeth Crofoot, Senior Economist at the Conference Board. You're listening to the U.S. Labor Market Roundup, our monthly podcast series where our labor market experts give you their reading of the latest jobs report released by the Bureau of Labor Statistics, and then provide insights on a special labor market topic. Today we'll react to the September jobs report. But by definition, movements in the unemployment rate and in job gains are lagging indicators of the economy. So for our special topic today, we're going to look into our crystal balls and discuss what we think the post-COVID U.S. labor market will look like in 5 years and the major trends that are going to get us there. Today, I'm joined by my two regular guests and colleagues. First, Gad Levanon, our resident expert on U.S. labor markets and head of our Labor Markets Institute, and Frank Steemers, our data guru and economist at the Conference Board, focusing on U.S. and global labor markets. Gad and Frank, as always, it's great to have you on the show.
Thank you, Elizabeth. My pleasure.
Thanks, Elizabeth.
Great. So let's dive right in. So in this last jobs report before the presidential election, on the face of it, we saw some pretty positive numbers. So employers added 661,000 jobs in September, and the unemployment rate declined to 7.9% from 8.4% in August, and that's down from nearly 15% in April. So despite this improvement in the unemployment rate, this is the first time since the pandemic started that job gains have actually fallen below 1 million. So with less than half the jobs added in September than we added in August, the pace of the labor market recovery is really slowing drastically. And it's most apparent in certain sectors of the economy as well. So in terms of where we saw the most movement, the bulk of the jobs that were added were in leisure and hospitality, so in restaurants, hotels, and recreational services. And the biggest job losses were seen in the government sector, especially among temporary census workers and in public education, so a lot of teachers. Further, the labor force participation rate reversed course and declined to 61.4% in September, which outside of the last few months of the pandemic is the lowest level we've seen since March 1976. So this means that more Americans are giving up looking for work and are leaving the labor force, which does not bode well for the economic recovery. Also, while the number of workers on temporary layoff has declined, those that have been on permanent layoff have continued to rise. And that's on top of recent announcements of looming layoffs by companies like Disney and the major airlines that also doesn't bode well for our future recovery in the coming months. So even though on the face of it, it looks like we're moving in the right direction, there is still some underlying fragility in this labor market. So with that, let's turn to our panel. Frank, like I noted at the top, the unemployment rate dropped by 0.5 percentage point from 8.4% in August to 7.9% in September, which is a pretty huge drop in relative terms. And in normal times, we just don't see that kind of movement on a monthly basis. Can you explain what drove this change?
Right, thanks, Elizabeth. I think there are 2 points to be made here. Of course, we now have very strong job growth. So before this crisis, often we had job growth, monthly changes of like 150, 200,000 jobs each month added to the economy. And over the last couple of months, we're talking about millions. And this month was, of course, less, but still 661,000 is a lot to push down the unemployment rate. Besides that, of course, there's also another large indicator that sometimes makes it a little bit difficult to understand the movements in the unemployment rate, and that is the labor force participation rate. So what happened this month was that there was actually a relatively large decrease in the labor force participation rate, and that often translates into also an unemployment rate that goes down deeper than it would have been if the labor force participation rate hadn't moved at all. So, for example, if we now look at the labor force participation rate of today, it's still 2% below it was in February. So the unemployment rate is therefore also much lower. So say we would still have had the labor force participation rate of February, people would not have dropped out of the labor force. The unemployment rate would have been about 2.5% higher. And with that, I don't want to say that the recovery in the labor market is worse than we think. I think it is very most important to look at the trend in the unemployment rate. But I do like to point out that it is sometimes a little tricky to look at all these different measures and to understand like how well the labor market is doing.
Right. And Frank, that headline unemployment rate can sometimes give us a really clouded view of the health of the labor market. Are there some other indicators that we should be paying attention to?
Yeah, so I think besides the labor force participation rate, which is an important indicator, we often look at the U6, so that is a broader measure of the unemployment rates, which is basically a measure that takes besides the unemployed also those into account that are working part-time for economic reasons. Of course, we know that companies have been reducing hours for workers, and therefore we saw a big increase in this group of workers. This group of workers has been shrinking, of course, over the last couple of months. But still, this can give a broader measure and tell us that we should not only look at those people that don't have a job, but also people who are not working as many hours. In addition, it also takes into account people who are not actively looking for work but still want to have a job, which is especially relevant in this crisis because some people may want to have a job, but they know it's still a little dangerous to go out, so therefore they might not be actively looking for a job. Then another measure, which is very simple, is just the employment to population ratio. So you just check, do you have a job or not a job, which is often like a better comparison to see how well the labor market is doing compared to another period. Overall, though, I would especially point out that in these last few months, there's still a lot of volatility, a lot of movement up and down in, for example, the labor force participation rate. I think what is very important is to look ahead and to think about what might happen in 1 or 2 years, maybe when we have a vaccine for the coronavirus. Will this group of workers directly go back into the labor market, or do we maybe have a structural decline in the labor force participation rate, which would be very bad for the US recovery because fewer workers would participate in the economy and help the economy go back to full capacity. So I think that is a big question that remains.
And there's been, the decline in the labor force participation has been very particular or targeted towards certain demographic groups, right? So it's
Right.
potentially reversing that progress that these groups have made over the last 10 years or so in the previous economic expansion.
Right. I think that's a very good point that you're making there, Elizabeth. We know, of course, that not all groups are affected equally. So it is especially a question for those groups that have been most impacted by this crisis. So minority groups, younger workers, those with lower educational attainment. For them, the job losses have been strongest. Therefore, it is also the question, is it going to be more difficult for them to return to the labor market even when the coronavirus is more under control? And I think that is going to be difficult.
Mm-hmm. And essentially, Gad, if I can turn to you now, all of these indicators that Frank has talked about are flashing signs of a slowdown in the labor market. So what's the outlook for the next several months?
Yes, I think we are going to see a slowdown. We already are in the middle of a slowdown. I think the main reason is that the reopening part is kind of exhausting itself. Most of the things that got shut down already opened, and there is less left to reopen. So that, I think, is the main reason. But I would say, in addition to that, the spread of the virus is kind of heading in the wrong direction in many locations, is going up, perhaps related to the weather or other factors, and that could keep more people at home, and fewer businesses will reopen. So that's not a good development. And finally, the stimulus. We've been waiting for good news about the stimulus, and we haven't seen any. It doesn't seem like much will happen before the elections. So that is impacting the ability of many households to spend. So that will also be a negative for the economy, at least in the next several months. So overall, I do think we will have a slower growth in the economy and in the labor market.
And like you mentioned, that slowing or the uncertainty around the fiscal stimulus, and that's on top of what we're seeing with the looming looming layoffs and company announcements. Those are just going to add to the pressure on the labor market and make the situation even tighter going
Yeah.
forward. So how does this recession compare to what we saw during the Great Recession? Are there any glimmers of hope that we can latch onto?
Well, when this pandemic started and everything shut down in March and April and continued to look bad in May, I think many of us thought that this recession is going to be worse than the Great Recession. But I'm starting to feel that it may be the opposite. The recovery has been stronger than expected. Um, we have those very large industries that are completely demolished by the COVID, travel, entertainment, hotels, the ones that you mentioned earlier. But there are also a lot of industries that are doing very well. Consumption of goods, for example, is well above pre-pandemic level. Business investment in equipment is doing much better than expected. Is actually back to pre-pandemic level, which is almost unheard of to see that happening in a period of recession. The housing market is doing well. Consumer confidence is not that bad. The wealth effect, in this time, both home prices and stock prices are above pre-pandemic level, which supports financial security and willingness to spend. So, in many ways, this is not a very severe recession, less severe than the Great Recession. Just as a reminder, in 3 years after the Great Recession started, the unemployment rate was still above 9%, and now we're already 8% and moving down. So I think all in all, especially if we have some vaccine development in the coming months and wide deployment during 2021, by the end of the 2021, we may conclude that this was not that was a very deep recession, but not a very long one, and in general less impactful than the Great Recession we had in 08 or 09.
Right. And I think that's also important to point out here that it also depends on what slice of the economy you're in. And there's a lot in the narrative right now in the dialogue about a K recovery and how different groups of individuals are really experiencing this recession very differently. So definitely on the aggregate, it seems like it's not as deep as it was. But of course, like in all economic stories, there's always certain slices that are going to be impacted much more than others. So
Yeah.
I think this is a really good time to take a break for some quick announcements. So we'll be back to discuss our special topic for this month, the post-COVID U.S. labor market and what we can expect in 2025.
Can you, your team, or your company benefit from insights such as the ones provided in this podcast? They are immediately available when you join the Conference Board, a membership-based think tank that delivers trusted insights for what's ahead. Reaching across industries and geographies, we bring together our noted experts, senior executives from the world's largest companies, and nonpartisan practical research to help you address your most important business issues. Our membership packages are tailored to your organization's unique needs and budget. To learn more about our offerings, go to www.conferenceboard.org and click Join on the top bar to connect with one of our product specialists.
This is Indications, and you're listening to the U.S. Labor Market Roundup, focusing on the September jobs report. And again, I'm being joined by Gad Levanon and Frank Steemers. Let's shift gears now to our special topic, the post-COVID U.S. labor market and what we can expect in 2025. So the COVID-19 pandemic, together with reduced consumption due to social distancing, is really driving the deepest economic recession that we've seen since the Great Depression. And as consumers remain reluctant to spend and as layoff announcements pick up, U.S. employment will be slow to recover to pre-pandemic levels in the near term. But eventually, we all know a vaccine will be found and the fear of the virus will dissipate. So we're asking ourselves today, how different will the U.S. economy and the labor market look like 5 years from now? So Gad, what do you think is the main economic related? So what are some of the main economic related trends related to COVID-19 that will impact the U.S. economy and labor markets in the longer term?
Sure. So I think the number one legacy of COVID in terms of the economy is the permanent increase in remote work. I think especially with about 6 months of experience, the perception we get is that most companies concluded that remote work works, and that a very large share of workers in many companies will primarily work from home in the future. And that will also will have it will have many implications, but one of them is related to hiring. We also learn from companies that many more are willing to hire hire workers 100% virtual work, not even in the metro area where the main office is. So they're willing to do it anywhere in the US, and some are even considering shifting some of those jobs outside of the United States. So that's probably the number one trend. But there's also the accelerated shift to online activity, online purchasing, payment, deliveries, but also things like higher education and health and banking. Much more activity is expected in online. Another important trend is in every recession we have a lot of companies, and they need to cut labor costs, so they find ways to become more effective with fewer workers by using technology and automation, and that's likely to happen this time as well. In particular, I think a lot of office support and clerical jobs, which have been very much replaced by technology in the past decade, that they are probably the ones that will see the biggest further automation in the coming years. Also, we are going to see a lot of bankruptcies and mergers and acquisitions and private equity activity. So when we come out of this pandemic, the ownership structure in many industries is going to look very different, and perhaps with more concentration in industries than we've seen before. And also, finally, the city centers are declining. Fewer people come there to work. Tourism and kind of museum, theater, that's gone for a while. And so spending in city centers is going to be much weaker than before, and some of this business activity is moving outside of city centers with a lot of business geography implications. So those are some of the main trends that I think will impact us even 5 years from now.
Yeah, I think all of those are really important. They're, one of the main themes around this pandemic is that it's accelerating many of these trends that had already existed before. And you mentioned remote working and also online purchasing and delivery. And those are two, I think, that are particularly relevant to many industries. And it's going to be the catalyst in disrupting these industries into the long term. One example is definitely in retail, for example. So we've seen the share of e-commerce jump to 19%, up from 13% in February. So like you mentioned, people are ordering food and shopping online. And all of that is really leading us to the apocalypse of the brick and mortar store, right? And we know that has come, it's here, and it's driven both by the pandemic and also by the accelerated shift to online shopping. So we're also going to see, as a result of that shift to online, thousands of store closures and bankruptcies, and with the additional pressures of automation. So all of these trends are really coming together, especially in the retail sector, to reduce the demand for workers in retail. So we're going to see less workers needed in the future, as certain types of occupations really in retail sales, there's a push for additional automation, because those type of frontline workers in retail are not only susceptible to automation, but they're also at the highest risk for transmitting the virus. So there's really an incentive for companies to try to reduce that risk, both for their workers and in their customers. So we're going to see automation really impact retail and also restaurants, which is part of retail, but that's another industry or other part of the segment of retail that has really been impacted by people ordering food online, and really shifting to picking up and delivering, or curbside pickup, for example. And the shift to online has impacted other sectors, right? You mentioned higher education. So we're seeing a huge shift in online learning that we're going to expect to see into the future as well, even after there's a vaccine and students can go on campus or go to their public school. We're still going to see a component of online education going into the future, especially in higher ed. It's going to produce possibilities for other students to gain additional training and education, because that online offering hopefully is going to bring down that price point, which has been another debate about increasing student debt over time. So in other industries, for example, the shift to online hasn't been quite as impactful. For example, in air travel and lodging, that's not really something that has impacted the demand there. It's really the fact that all these travel restrictions have reduced business demand, which is the majority of the revenues for airlines, for hotels. So those types of companies are really going to suffer as businesses realize that they can easily do Zoom calls now. They don't need to invest in the amount of travel that they did before. So in the future, we do expect that there's going to be less demand for air travel and lodging, and it's really going to be up to the consumer, right? Leisure type of travelers which we expect to come back in the longer term, but overall, that industry is going to be impacted severely. Another industry to mention is transit and ground transportation, which also isn't necessarily impacted by the shift to online, but again, because everyone's working from home, because of the trend to online conferencing and other forms of remote work, we're not going to see the amount of people commuting to and from work that we did before as well. So that's also going to reduce the demand for transit and ground transportation workers in the future. And talking about leisure and entertainment, overall there, the thought is that in the long run, people are going to be really craving those type, leisure and entertainment outside of the home. After several years of streaming videos on your couch, people are going to want to have different experiences. And in the longer term, we do expect that demand to come back. And with that, labor demand in those types of occupations and in that industry. So that shift to online is really sort of the anchor that is driving many of these other related trends in these industries, and also ultimately going to affect how labor is demanded in those particular industries. So, Gad, if we can move on to talking about some of the occupations that we expect to be disrupted as we move forward through 2025, is there something that you can tell us about, what types of jobs are going to be most impacted?
Yes, I think on the positive side, there is going to be a strong growth in the demand for tech workers. So, as we talk about the shift to online in many industries, that will create a bigger demand for tech workers and new markets for tech companies. So I expect, and that's already been the types of jobs that grew very rapidly in the past several years, and they will even their growth will even accelerate, I think, in the next several years. On kind of the negative side, I think, as I mentioned earlier, office and administrative support workers and clerical clerks, those jobs have been automated in the recent years and are likely to be eliminated. Quite a lot of jobs in those occupations will be eliminated. Those jobs also that were mostly done in the office. There was not a lot of remote work in those jobs before the pandemic, but now we are going to see many more of those jobs done remotely. And as you mentioned, sales jobs, because of the shift to online shopping and automation, we're going to see fewer sales workers in the future. And I think many white-collar jobs that were done in the US, that worked in the US, may be offshore. So we're going to see across the board many types of jobs that will be done in the US in the coming years. So I think those are the most impacted types of jobs.
Great, Gad. Those are some really important insights about how occupations are going to be changing in the longer run as we look ahead. And I think that's all the time that we have for today. This has been a really good conversation with Gad Levanon and Frank Steemers about the September jobs report and the post-COVID U.S. labor market. Gad and Frank, thanks again for being here.
Thank you.
Yeah, thank you.
And thanks to all of you for listening. Please join us for next month's U.S. labor markets roundup, where we'll be discussing the October jobs report and our short-term labor market outlook. If you enjoyed this program, please subscribe to Indications and other podcast series from the Conference Board through your favorite podcast app. Thanks again for listening. I'm Elizabeth Crofoot with the Conference Board.
This has been Indications from the Conference Board.